it's really hard to enforce and say nobody can memorize 12 words and therefore own Bitcoin. But what they can do is say banks can't send to crypto exchanges, right? They can do that with a stroke of a pen. And they did that in Nigeria. The central bank said, look, banks cannot send money to crypto exchanges. But what happened was people were so well versed on the failing of their currency and the attractiveness of things like dollar stablecoins or Bitcoin. And so they developed the largest peer-to-peer trading volumes in the world to go around the banking system.
Lyn, it's so great to speak with you. Thanks for joining me. I was watching a bunch of your interviews to prepare for today, and one of the things I've seen you talk about is you compare the 1940s to the 2020s, which is pretty ominous, right? And kind of scary. And I share a lot of your concerns. I tend to focus more on the geopolitics, where I also am seeing a lot of similarities. Can you walk me through why you think the 2020s are similar in many ways to the 40s?
Sure. And first of all, thanks for having me on. Happy to be here. And so I find that 1940s comparison is very instructive for a couple of reasons. And I primarily, when I talk about that comparison, I'm more talking about the fiscal and monetary policy situation rather than geopolitics, although they do tend to feed into each other. And so when we look back at the prior two inflationary decades in kind of developed market history, there's the 70s and the 40s. And you can go back further than that to the 1910s, but focusing on those two decades, they had very different reasons for why that inflation materialized. So when most people think of inflation, they think of the 70s. That was the most recent one. But what's important to know about that environment is that most of it was driven by the private sector. So most of the new money creation that was happening was because banks were lending a lot of new money into existence. That was the baby boomers were entering their home buying years. That's peak credit formation. So you had a demographics-driven credit expansion at the same time as you had, constraints in the oil supply. So you had real world, real asset constraints at the same time as you had above target money supply growth from that private sector. And then overlaid on top of that, you did have fiscal deficits, but they were actually a smaller piece of the puzzle. In addition, public debt was very low. And so the way to deal with that type of rapid private sector credit expansion was that they could raise rates sharply and kind of purposely put the economy into recession, kind of slow down that. And that was a pretty effective way to get inflation under control at the cost of recession. When you go back to the 1940s, you had a similar average level of inflation. You actually had in one part you had slightly higher year-over-year inflation than even the 70s. But overall, that was a similarly inflationary decade, but it was for completely different reasons. There was very little private sector credit creation, and instead, most of the inflation was from fiscal-driven, like monetized fiscal deficits. So it was fiscal-driven inflation. The government would run enormous deficits, pay for things, and have a large portion of the bonds bought by the central bank and by the commercial banking system broadly, which is a way to lever that up. And so they get a multiple on their bond issuance. And basically what they're doing is they're putting currency into the economy more quickly than they're pulling it out of the economy to such a magnitude that it just overrides everything else. And obviously that was war related, but a lot of it was building manufacturing facilities, getting commodities. When the GIs came home, putting them through technical training in college and subsidizing their mortgages. So a lot of it was actually kind of domestic nominal stimulus in a way. And so that fiscal-driven inflation environment was different. In addition, they had high public debt to GDP. Unlike the 70s, they had, because of all that war-related era, they had well over 100% public debt to GDP. And so they didn't really see themselves being able to afford higher interest rates. So despite the fact that they had very high inflation, they just suppressed interest rates anyway, in a similar way that Japan's been doing recently. But imagine if Japan had, 6% average inflation and was still holding rates where they are. That's basically what they did back in the 40s. And so the reason I make that comparison to today is that much of the inflation we're seeing, and I started making this comparison in 2020, so before we saw a lot of this inflation, but we started to see the early signs of kind of fiscal stimulus in response to the pandemic. Basically, if you looked at the numbers of what we were seeing in financial markets, it looked like a war. Even though it wasn't a war, it was pandemic stimulus and lockdown stimulus, and you had supply chain disruptions and a big increase in money supply. It looked like war financing, and it's kind of mathematically very similar to that. So you had this huge fiscal-driven inflation, and you have well over 100% debt to GDP, and so that puts us into more of a fiscal dominant situation. It's more like the 1940s than like the 1970s. And then unfortunately, sovereign debt issues and kind of political polarization can lead to geopolitical instability. So they can kind of feed off each other. So when I originally made that comparison, I said, well, hopefully less kinetic than the 40s. Unfortunately, since I've been making that comparison, we've obviously seen an uptick in geopolitical issues as well. So it's actually even more closely aligning with the 1940s than I initially intended. But the problem is those two risks tend to feed off each other. The only other kind of caveat I would make is that back in the 1940s, the US was running a structural trade surplus. The UK was running a structural trade deficit. I think overall, the US today in the 2020s looks more like the UK from the 1940s than it looks like the US from the 1940s. So it's not that it's a perfect analog. There are some differences, but I think that that's a period that's worth knowing about when you're kind of navigating this environment because it's a different environment than we're used to over the past, call it 40 plus years of even a long-term investing career. You have to go back to history books and other things like that to have somewhat of a playbook for how this type of situation tends to unfold.
In fact, I just noted that, is COVID, it was the pandemic, sort of the fiscal equivalent to a war. And I think in many ways it was. But you note that back in the 40s, there were other reasons to keep the stimulus going, a big generational surge working through the system where we don't have that now. I mean, we've got a U.S. economy that's growing at a surprisingly high rate. Unemployment's below 4%. Things are generally, on average, good, and yet our deficits are blowing out. We've got a Fed that's talking about potentially cutting rates. They talk about quantitative tightening, and yet fiscal conditions are pretty loose, I would say. Is it any surprise that inflation is sticky right now?
So I think that is fueling it. And that's, so in early 2022, I was bearish on a number of things. And I started to realize by kind of late 2022 or early 2023 that fiscal side was reaccelerating things for the reasons you described, that even though we're in an economic expansion, the deficit was accelerating. And a lot of that is because of interest expense. So one of the main differences between a normal fiscal environment and a fiscal dominant environment is that in a normal fiscal environment, where most money is coming from private sector credit creation, if they raise rates, they can slow that down more so than they increase public interest expense. Whereas if you have huge debt to GDP and you raise interest rates, although you do slow down private sector credit creation, you increase the federal interest expense by an even larger number, and that's pouring into the economy. That's expense for the government, but it's income from someone else. And some of that has a non-zero propensity to spend. It doesn't circulate as quickly as say stimulus checks do, but it does circulate in a non-zero way. And so that's actually money that's pouring out to varying degrees into the private sector. So when you combine that with, demographics, kind of like how in the 70s, demographics were a key part of inflation because you had boomers entering the household formation years. Now you have that on the fiscal side, which is that baby boomers are entering their retirement years. And so some of these programs that were built decades ago with certain mathematical models in mind look different now. And so it's a more top-heavy thing, and that's another form of kind of stimulus. And so I think the risk that we have in the 2020s compared to the 1940s is that it's a more somewhat stagflationary type of thing because it's not a lot of that fiscal deficit is not going, it's not like a big one-time burst of new building and war fighting and things like that. It's more of this long, drawn out imbalance that we're going through. So the initial part was like COVID. That was more like war related. But now the more structural thing is that they've tilted the system so much they can't really get those back under control. And so we have a higher background level of stimulus now, of nominal inflation now, because this, like you said, this is pouring into the economy, despite the fact that we have low unemployment, despite the fact that we have no recession, we're running these very big deficits. So we're almost pre-stimulating before we get a recession, which makes recessions either harder to get or they look differently when they arrive because they have almost like an emerging market like quality to them. If you look at recessions in emerging markets, often the currency is weak enough that recessions just look different because it's a different monetary environment. The denominator is different.
So why do you think it is that they're reluctant to pull liquidity out of the system? Is it because the system just can't handle it? I mean, is something at risk of breaking, maybe in the banking system, if liquidity comes out?
We saw that before. We saw early signs of the banking system running into issues when they actually were pulling liquidity out of the system. So for much of 2022, we had net drawdowns in liquidity. And if they wanted to follow through with disinflation, when you had banks failing, you could have people lose some of their uninsured deposits. But they didn't want to risk instability spreading through the system. So given the choice between destroying some deposits or backstopping the whole system and providing liquidity anyway, despite still above target inflation, they chose the latter. And if you look in history, that's usually how it works out. They usually choose inflation over either nominal sovereign default or nominal banking crisis, as long as they control their own currency. So maybe if you're Greece, it won't be that outcome. But if you're a country that controls your own currency, that's almost every single time that's the outcome that they choose. Also, the challenge is that all this debt is built on a highly financialized economy. So, for example, if you look at deficits, they're highly tied to asset prices. So when asset prices are rising, that's pretty good for tax revenue. And when asset prices start to go sideways or down, that's pretty bad for tax revenue. And not all countries are like that. We in the US, we've tied our tax structures more so to that kind of asset price situation. We financialized our tax base more. And so the problem is, even if you try austerity and you kind of say raise taxes and lower spending in various ways, that might be effective for a little while, but then the problem is your tax base is probably going to be weaker than you think, and you're going to get a bigger deficit because of that reason, which makes the combination of a financialized economy and high public debt it's a hard tailspin to get out of. And so I think that's kind of the underlying issue there. I think that's part of why this is looking the way that it is.
I need a quick break to tell you that the Strategic Investment Conference is right around the corner, and you should be there virtually. It's a virtual conference, online only, attended by thousands of investors around the world. Our lineup this year includes Felix Zulauf, David Rosenberg, Lacey Hunt, Louis Gave, Danielle DiMartino Booth, Lyn Alden, Neil Howe, Howard Marks, Leon Cooperman, and over 30 other economists, investors, and analysts. The conference is live. It begins on April 22nd. We'll have 5 full days of presentations spaced out between April 22nd and May 1st. Everything will be recorded so you can watch or listen later. We'll have transcripts and an interactive chat room for Q&A. I really hope you'll join me and John Malden for the 20th Annual Strategic Investment Conference. Register today at sic2024.com. So all of this makes me think of several passages in your book, and I just want to make sure I mention it. Broken Money. I have to say, when this came in the mail, I opened it up and I looked at the back page and said, wow, 500 pages. I didn't know what I was getting into. But the cool thing about how you basically take people from the history of money, I guess, trading in seashells right through to today's current system and then perhaps even tomorrow's system with crypto. But you do it in a way that anyone can read. And I really, really appreciated that. So I want to kind of talk a little bit about some of what's in here and how it leads to what we were just talking about. One of the things that you write about is that currencies, I guess what I would call modern day currencies, fiat currencies, currencies issued by a government, generally start out as a good thing. Like they're presented as a solution to a problem, and they're a way for a society to facilitate commerce. But that over time, the same thing tends to happen to every fiat currency. Can you walk us through sort of what that evolution is?
Sure. And the way I would describe that is that for many centuries, almost every friction in money is solved by another layer of centralization. And so when we think of the history of monetary technology, there's obviously the physical component. As we got better at making shells or better at making grains, they became diluted as money, whereas and things gravitated toward gold and silver because those are the commodities that it's harder for us to make more of even in an industrialized setting. It's hard to make them at a rapid rate. So there's that physical component, but then on top of that, there's all the banking technology. And that started with technologies that we don't even think of as technologies today because they're so straightforward. Things like coinage, things like paper, bookbinding, the printing press, analog encryption techniques, so you can't have like papers be copied and forged. Those are all analog layers on top of it. And then you, of course, had digital layers, things like the telegraph, the telephone, the internet, blockchain, right? These are all technologies that are an additional layer on top of these things. And, for most of human history, both transactions and settlements were slow because everything was moving at the speed of matter. That was pre-telecom. Now, once the telecom era began, which I kind of define as the 1860s or 1870s because they invented the telegraph in the 1830s, but then it wasn't really kind of run long distances until the 1860s. That's when we kind of entered the kind of developed world entered that connected environment. And so now we were in an environment where transactions could move at the speed of light because all that takes is fairly low bandwidth information. But settlements, things like physical shipment and verification of gold, was still slow. And so in that pre-telecom era, the usefulness of middlemen was limited. They were solving problems, but in an analog way, and they were more optional to use. Whereas in that kind of post-telegraph environment, because settlements were slow and transactions were fast now, those middlemen were doing a lot of work. The banks, the central banks, they're serving as that abstraction layer on top of that much slower layer. And there really wasn't a lot of alternatives. Basically, you had to trust someone's ledger and they kind of went down the stack. So if I wanted to send money to you for some sort of commerce, we could use the same bank and just use them as a trusted intermediary. If you're using a different bank than me, then our banks have to be able to communicate, and so eventually they have a central bank under them, and they can just like I can just tell them to send money to you, they can just tell the central bank to debit their account and credit the other account. And then you have an issue of how do central banks around the world coordinate if we're in different countries who want to send information. Well, what they do is they coalesce around the biggest central bank. So in the 1800s, that would have been the UK. Now it's the US. But that all those kind of major central banks tie into the biggest one. And so you have individuals built on banks, built on central banks, built on the biggest central bank. And it's just layers of abstraction. And it's all really solving that mismatch between fast transaction speeds and no quick way to final settle value. And so that's kind of the era that we've been in. But the problem is when you have that power coalesce down to central banks and policymakers, and especially a couple key major central banks, that over time tends to degrade. Whenever there's a problem, they tend to resort toward debasement. It's generally a smoother solution than raising taxes or cutting spending, which is very popular. An example we just discussed, when the banking system ran into issues in early 2023, instead of saying, look, I mean, if you had uninsured deposits, they might be gone now, or you might get 80 cents on the dollar, and that's the risk you took. Instead, they say, no, we don't want this to spread through the system. We're going to add liquidity even though we have above target inflation. We're going to back deposits even that weren't fully insured, because that tends to be it's like accumulation of those little decisions over time. And so now we're in an environment where decades of those decisions led to very levered middlemen, let's say, very levered governments, very levered central banks. And now we have new technology that allows us to do fast settlements for the first time. We can do fast settlements long distances internationally. We can run a decentralized ledger. It came about as early as it could because you can't really do that until bandwidth and encryption techniques and overall global connectivity got to the level that it did in the past couple decades. But now that's there, that's a new alternative that's being tested and is kind of like a new challenger up against that older model. And I think that what we're seeing now is this ongoing friction point where you have this new technology, but you have, of course, challenges building it, scaling it, and testing it, and fitting it into existing regulatory structures. That's all happening on one side. On the other side, you have just decreasing stability from the incumbent systems because the results of all those accumulated decisions have really built up to a point where it becomes critical. And I think that the point that's really worth emphasizing is that for 40 years, let's say in the US, we've had rising debt to GDP publicly and falling interest rates. And that's been a kind of a one for one offset. And if you double your debt, but you cut your interest rate in half, your debt service remains the same. But after 40 years, if you run into zero and bounce off zero and start going sideways to up in terms of your interest expense, while you still have that structural deficit, that's when that actually starts to become more acute. And so I think that's the phase we're in now, which I think is still a fairly long phase. So basically, we have a gradual destabilization of the current system, and along with new technologies that people can turn to, with a lot of friction in between.
Just as an aside, it's funny you bring up the issues of 2023 with the potential banking crisis and Silicon Valley Bank. A good friend of mine who I can't name, but he's the CFO of a Silicon Valley tech company that had just gone through a funding round. So, and I happened to be in New York having dinner with him that night when it all started to happen, and his phone started blowing up, and he took a call in the back room, and he came back 5 minutes later, and he said, "Look, we've got $35 million that we just raised on deposit at SVB, and the CEO is on with me asking me if we should transfer it." And that really rammed home for me how vulnerable the system is right now, because the CEO was literally had his finger above his keyboard and was just waiting for my friend to weigh in on should we move it or not. And, $35 million with a click of a button goes out, and he's one of hundreds, if not more, CEOs going through that same decision process in that very moment. So, that bank got the deposits got vaporized. Pretty amazing how that all played out.
Yeah, bank runs used to be analog,
Right.
and now they can happen back end digital, APIs. People can move money around a lot more quickly, and that changes the liquidity needs of banks. And I'm involved in Bitcoin venture. And the funny thing is, they were Bitcoin companies. I mean, a lot of their expenses are still in fiat currencies, even though they're operating in a Bitcoin environment. Some of their employees often might accept salaries in Bitcoin, but not all of them, and they have real world expenses that they're building on top of the incumbent system. So they have to connect with that incumbent system at least for a period of time. And the ironic thing was they were worried about their bank accounts. It's like the irony of Bitcoin companies worried about the stability of the dollar system, and how it can threaten their business. They're like, should I move to this bank? Should I stay in this bank? I mean, which banks are safe? I'm not sure. Because if you're running a business, you're often operating above certain FDIC limits. Now you're thinking about sweeping money into money markets when they're not in use, and it's like, should I do that? And so it's like they suddenly had to become plumbing experts in how the dollar system works because they didn't want to risk missing payroll for a multi-week period or something like that. And it's the irony of the situation. It's supposed to be that the fiat currency system's stable and that this is like this new frontier. And yet all these new frontier companies were like, yeah, I'm glad I have some Bitcoin on my balance sheet because, if I really need to make payroll and my bank's frozen or something, at least this is like a separate source I can turn to. And it just shows how messy the situation got in that time.
It seems to have accelerated. I mean, like it really feels like the financial system in the U.S. and I would assume in several other developed countries has become scarily fragile in the last few years. you write about Bitcoin in Broken Money. Um, Probably the biggest aha moment for me from your book, being a 55-year-old U.S. Citizen who's been skeptical for the most part of Bitcoin, and I haven't done the deep work like you or Dan Tapiero has done and read the Satoshi white paper, which is one of the reasons why I really appreciated Broken Money, because you spoon fed it to me. But the big aha moment for me was you taking me as a reader out of the U.S. and showing me Bitcoin from a different perspective. And you talk about how Bitcoin isn't necessarily going to displace the US dollar tomorrow, or the euro, or the Swiss franc, or even the yen. But think about what Bitcoin could do for you if you lived in Argentina, where I've been to, and I've seen the horrors of decades of inflation, or where you sometimes live in Egypt, or Lebanon, or pick any of probably 120 or so countries in the world. Can you talk a little bit about kind of how Bitcoin can play a really special role in the everyday life of someone in or outside of the reserve currency worlds?
Sure. So in that world I mentioned where there's slow settlements and fast transactions and really thick middlemen, basically it all becomes a centralized financial stack. The result of this is that there are 160 different currencies in the world, and all of them have local monopolies over their own jurisdiction, and then most of them tie one way or another into the dollar system. They hold dollar assets, they have dollar liabilities, they can use that as the kind of their stabilization substrate. Um, but basically, there's these 160 different monopolies, and when you think of how they work, they are really not that different than arcades or casinos in the sense that they issue a token that really only has value in their monopoly. So when you go to an arcade, you get arcade tokens. It only has value in the arcade. If you try to take out the arcade token, it's useless. Um, and maybe the restaurant next door accept it because maybe they have a deal with the arcade, but a mile down the street, no one's going to accept it. Same thing's true for a casino. And basically, these fiat currencies operate in a similar way. That when you go to Egypt, the Egyptian pound has local value, but when you try to bring the Egyptian pound almost anywhere else, you're gonna quickly find that no one accepts it. It's even hard to convert it. It just loses like 90 some percent of its moneyness when it's anywhere outside of its monopoly jurisdiction. That's true for almost every currency in the world outside of the top five or so. Um, and most of them rapidly lose value. Um, and the people in there, their wages and their savings are denominated to a significant extent in that local currency. And so they're on this treadmill to kind of constantly keep up with that dilution that's happening. And capital controls are generally used to keep them in. That's how those currency monopolies are enforced. And it wasn't always like this. This is how the current system works. And when you think about the two ways to get money in or out of a country, there's there's ports of entry, so airports. You can obviously only bring so much cash or gold through an airport. They're heavily restricted and surveilled. Or you can do wire transfers, bank transfers. But those are of course heavily surveilled, regulated. They can set artificial exchange rates. They can determine who in a country can get accounts in other currencies. If you want to be in a country and you want a dollar account, they can dictate the rules of how that works or who can access them or how wealthy you have to be to access them. If you're in one of those countries and you do have a dollar account, it's basically a levered bond fund with no backstop, right? They don't have a tie to the Fed. And so imagine Silicon Valley Bank, but there's no Fed there, right? So when you're holding dollars in a bank outside of the U.S., you better be pretty sure of the solvency and the liquidity of that bank because you're holding a fractional reserve dollar claim with no mechanism to enforce that really. And so you come to realization pretty quickly how unstable a lot of that system is. And essentially what things like Bitcoin and stablecoins do is they reintroduce choice to people. So instead of just having their local monopoly and only a couple ways to get in or out of it that are all tightly controlled, it kind of cracks open all those borders. So there's 40 currencies in Africa, there's 30 currencies in Latin America. Everybody has their own little, they're stuck in their own little monopoly, constantly getting debased. And what things like Bitcoin or stablecoins do is they say, if I'm doing work with a Nigerian graphic designer, right, they can, and they want payment. They can tell me what form of payment they want. They can hold up a QR code over a video call. They can send me a payment string with email or a DM and go around their local banking system and say, I want payment in stablecoins or I want payment in Bitcoin. And then it can just bypass their system. They can hold it, that they can transfer it. You can bring unlimited amounts through an airport, for example, by memorizing 12 words. Just all the porousness of those 160 currency borders becomes a lot bigger, a lot more porous, and it reintroduces choice of money. And of course, that comes with friction. Some countries tried their best to slow that down, but especially the worse their currency is, the faster people look for alternatives. And what stablecoins do is they say, okay, this is centralized, but the central hub is outside of that country. It's in another country. It's in the U.S. or it's in Italy or it's in country XYZ. It's outside of the country that's having the currency problem, and so people can choose to trust that. It's kind of like offshore bank account for the middle class instead of just the wealthy. Or you can have a almost completely decentralized version like Bitcoin that says there really is no central hub. It's this kind of interconnected swarm that exists, and it's this network that exists as long as the world has an internet, basically. And it's a decentralized monetary alternative. So I think that's the context to think of as these technologies come around, is that they kind of pierce open this currency monopoly situation that only exists because prior to Bitcoin, there was no such thing as fast global settlements. There's either no settlements at all, or you settle with physical gold, for example, which is, it took Germany years to repatriate their gold from the U.S. famously, and they were happy they finished ahead of schedule, and ahead of schedule was still years. Um, that's how large movements of value work in the modern era, and Bitcoin can settle global value in an hour. So it's a different technology.
So, from a government perspective, Lyn, it's all about taxation, right? So how does a government think about a threat to their currency and a threat to their revenue stream? Um, what could that look like? Could there be a solution to? I'm not talking about. I want to get into what the path forward is for the U.S. and the other large nations of the world, but setting them aside for a minute, what is a country who says, all right, maybe we don't need to worry about this so much? How do they protect their revenue?
Right. So historically, there's a couple of things. One, it's about taxation, and the other one is about kind of benefiting from seniorage, right? So the government kind of quietly debases savings and is able to use that gap to kind of make up the difference between, taxation and spending. Um, so basically, to some extent, by holding a currency, you're kind of giving the government like a small kind of like rolling below market loan in a sense. Um, and so they benefit when people want to hold the currency, and when they're paying taxes and things like that. And they run into trouble when they mismanage it enough that people don't want to hold that currency anymore. They want to hold other assets, and then the velocity of their currency starts increasing a ton because it's like a hot potato. People only touch it when they absolutely have to, and then they don't want to hold any more than is needed. Historically, governments respond to that with capital controls, right? So if you're in Turkey and you're dealing with massive inflation, you try to get dollars, they try to do things to limit dollars. If you try to borrow Turkish lira and use it to buy dollars, they try to restrict that. But then the problem is by introducing capital controls, they make capital want to flee even more quickly, or they make capital reluctant to come in, because now you have kind of a shifting rules area, and so kind of instability feeds into more instability. And that tends to be the problem that they go through. There has been a number of things in so India, like their central bank tried to ban crypto, and their own rules-based system kind of prevented that from happening. There's pushback, and that kind of got walked back. Nigeria's been interesting because it's really hard to enforce and say nobody can memorize 12 words and therefore own Bitcoin. Or you can't run this open source software on your aged laptop. It's just a very hard thing to enforce. But what they can do is say banks can't send to crypto exchanges, right? They can do that with a stroke of a pen. And they did that in Nigeria. The central bank said, look, it's banks cannot send money to crypto exchanges. But what happened was people were so well versed on the failing of their currency and the attractiveness of things like stablecoin, dollar stablecoins or Bitcoin. And so they developed the largest peer-to-peer trading volumes in the world to go around the banking system. And 3 years later, the central bank kind of walked back and said, well, maybe we'll let that happen, but we'll regulate it, right? And it's kind of they realizing that a carpet ban is just not working. And so basically, when governments run into these frictions, they do start to try to clamp down on the borders. Argentina a couple years ago, they were banning crypto from their banking apps. They were even trying to ban it from their fintech apps because people were using it as a release valve. They try to block the exits, but the problem is you especially in a well-connected society. So we're not talking North Korea here. We're talking a well-connected society. It's really hard to fully block the exits, especially with this new technology. There's multiple ways to go around it in a way that is a lot more powerful than analog technologies of a few decades ago. So I think basically the answer that most governments should do is try to encourage business to be there. They say, look, you want to have your business here, you want to own the assets you want to own, that's fine. And they can face short-term pain, but I think that being an attractive place to do business and having rule of law and having open capital markets and kind of open freedom of information is generally how economies develop most of the time. So I think that there will be frictions, but yeah, generally the answer is not doesn't work well when they try to just keep closing off.
You brought up India. India has been really progressive in many ways, and they've sort of accelerated the whole modernization of their financial system and gone. They've taken a country that was almost wholly unbanked, except for the truly wealthy, to now being mostly banked. It sort of leapfrogged us in many ways, right? But they have a central bank digital currency, which at first blush sounds interesting, right? It sounds modern. They have adopted, they use the blockchain, and they have their own currency. But there's some pretty serious negatives to a central bank digital currency. Could you maybe talk a little bit about India specifically and just CBDCs in general?
One example in India is that there has been issues with, say, political opposition running into financial issues.
Oh,
For
wow.
example, funding can be blocked, it can be surveilled, it can be targeted. That's been a non-trivial issue there. It's true for a number of other countries as well. For example, I met protesters in Nigeria. They were protesting police violence, and their bank accounts were frozen. So they started turning to Bitcoin donations, right? The late Alexei Navalny in Russia, when he was opposing Putin, their organization's bank accounts were frozen, so they would turn to Bitcoin donations and things like that to try to go around that. That's something that in a number of countries and there's not just one level of that. There's different levels of how tight that is. It could be kind of minor around the margins, or it could be more significant. Even in Canada, for example, when there were protests, the trucker protests related to various kind of pandemic measures, there were some frozen bank accounts that were kind of before the rule of law, saying you haven't committed a crime, but by this emergency decree, your bank account's frozen, and we'll sort it out later. And so people were like, well, we'll go around it then. So I think, yeah, the major risk of central bank digital currencies is that they further centralize the system. They make it so that every transaction is surveillable, everything is programmable, controllable. If you engage in a protest and AI surveillance cameras catch you in it, they might just automatically say, anyone who was in this protest, hey, your money's frozen for 72 hours except for within 1 mile of your home and only for essentials. And there's all sorts of automated big data things you can do to control people. And you don't have to be a conspiracy theorist. You can just look at China's social credit score or look at authoritarian or semi-authoritarian countries today, and that's kind of a rising issue around the world. They're saying, "Hey, you posted this on social media, and therefore your bank account you've been debanked, and you don't have access to that anymore." That's a rising issue, and so some of these technologies represent release valves that people have one foot in another more decentralized system that they can turn to when they are deplatformed, debanked, or frozen, and things like that. And I think that's going to be that's not like a near term story. I think that's going to be a recurring friction point between people and policymakers, probably for well into the next decade.
Yeah, agreed. Terrifying amount of control. On the other hand, I mean, let's talk a little bit about some of Bitcoin's potential vulnerabilities. Andy Greenberg from Wired magazine, he's a journalist at Wired. He came on Global Macro Update maybe a year ago or so. He wrote an amazing book called Tracers in the Dark. And it told the story of how several governments, including the US government, tracked down one of the heads of the largest dark web criminal organizations. It was mainly a place where you could order illicit drugs online, but and worse, right? It only got worse from there. But the way they found this person who was living in Thailand, I believe at the time, was by tracing his Bitcoin transactions. And it wasn't easy. They had to piece a lot of pieces together, and it took a lot of people to do it. But my point is they did it, right? Is Bitcoin traceable? And what else could a government do to sort of mess it up?
Right. So the base layer is traceable. It's pseudonymous, meaning that it doesn't link names to addresses. But if you do somehow link a name to an address, like let's say, for example, you make all exchanges give you information, and then someone buys Bitcoin and pulls it into their address, you now link to that address, and you can therefore track that address across multiple transactions. And there are private cryptocurrencies that avoid that, but the problem is they make the sacrifice of auditability. So one of the reasons Bitcoin has value is because there's only going to be 21 million coins. That's a distributed rule set, and you can audit it at any time in open source way. You can directly audit the current supply of Bitcoin. Whereas in those privacy coins, you could have an undetected inflation bug, for example, and it's hard to prove a negative that there hasn't been some sort of undiscovered inflation or undiscovered debasement that's happening compared to when you have a more auditable system. So in Bitcoin, there are ways to make it more private, and those are generally layers on top of the stack. So for example, Lightning channels or Chaumian and eCash, these are ways to kind of privatize transactions on higher layers of the network. And the general way that it works out is that the smaller amount of value that you're moving, the easier it is to make it private, right? So if you're a human rights activist in authoritarian country XYZ and you want to move around a few $1,000s, that's generally doable. If you're a billionaire doing something illicit and global authorities are after you, you're gonna have a lot of trouble moving around that money privately, which is probably a good thing in most contexts. So it's privacy is really tied to liquidity in this sense. Even when you use those privacy coins, the downside is they're so small that the getting in or out of those coins is a pretty surveilled kind of bottleneck for privacy. So I think that the short answer there is that there are techniques to make them private. They're building over time, but they're not impenetrable. And when you look at how kind of global illicit financing works, I mean, the large banks in the US and Europe have paid literally hundreds of billions of dollars of fines over the past 25 years for all sorts of things, including massive money laundering. And so the vast majority of money laundering occurs in cash and in banks, ironically. around the world. And generally speaking, these digital technologies are not the best things to use for illicit activity. And I do think over time, privacy will be more and more introduced into the system, but it's generally that bottom up way. The smaller amount you're using, the more likely you can use it in such a way to be relatively private. Versus if you're large, if you've done something that has angered multiple people and they want to use resources to track you, there generally will be probably ways to do that.
One last question on currencies, and then if you have a few more minutes, I just want to quickly flip over to a couple of macro questions. John Malden has been writing about what he calls the Great Reset, different than the World Economic Forum, but he calls the Great Reset this event, this credit event that happens at some point in time where basically all the developed nations acknowledge that we can't pay our debts, and there needs to be and there is some sort of global settlement of some sort, some big washout and debt reset. He's been writing about this for probably 8 or 9 years now. How do you see sort of where we're at in terms of debt levels across the world? How do you see it playing out? Do you Bitcoin is one direction, a great reset and a new regime of fiat is another? What do you think the possibilities are?
So historically, in these long-term debt cycles, resets tend to occur with like a 1-2 punch. First, there's a big rotation from private sector debt to public sector debt. For example, the global financial crisis, the banking system kind of got reset. And the way that worked was, a lot of the debt was kind of pushed up to the sovereign level. And so that was like, I would call it punch one or phase one of the reset or the recapitalization, however you want to call it. The second phase is what happens when public finances are so indebted that their interest expense becomes problematic, and either that can resolve itself in one of different ways. For example, the 1940s, they used yield curve control. So we talked about the 2020s compared to the 1940s. The reason I make those comparisons is because that's generally when they went through those public sector resets, recapitalizations, different ways to describe it. And they can occur nominally. If you have external debts, you can just default on them. That's one option. Obviously, there's consequences for doing that. The other option is to default in real terms. So you print a bunch of currency, you hold rates below the inflation rate for a prolonged period of time, and people that were holding cash or bonds, they got a big haircut. They lost 30, 40, 50, 60, 70% of their purchasing power, maybe more in some cases, and they still get paid back nominally, but now nominal GDP is much higher relative to the debts that were just sharply devalued. And there's a couple different avenues to do that. They can do yield curve control. They could do gold recapitalization, for example. They can, there's ways to kind of recapitalize their sovereign balance sheets in a way that sharply devalues currency, either in a longer term time frame or in a non-linear time frame, like over the weekend. You can just do this big kind of decision that happened. And generally, defense against that from an investor standpoint is to own real assets and, if possible, to have debts denominated in the currency that are manageable. Long-term fixed rate mortgage or long-term corporate bond or something like that. You're shorting the currency, you're owning real assets. The challenge is that when countries do that, they also try to do capital controls or block the exits. They try to say, well, if we're going to devalue the currency, we're going to restrict this type of lending, for example. So we're going to make it harder to short the currency and borrow the currency. Or they say it's illegal to own this type of asset, which, is harder to do now than it was in the 1940s. Now we have social media. Now we have we're more connected. We're less unified than we were. So that it's hard to enforce that, but it's an option. They say, look, you can't own foreign securities, or you can't own XYZ, or if you have this much money, then these other rule set applies. They try to basically block the exits as much as possible, and then do that kind of deval. That's kind of the big risk that people face. I think that's going to be a lot harder now because now we have social media and now we have globally portable capital, things like Bitcoin, that allow people to move around more or communicate what's happening in real time more. And so it's hard to kind of do those things that rely on obfuscation. A lot of times in emerging markets, when you'll see ongoing currency weakness, they'll say, "Look, this is a result of speculators attacking our currency, and therefore we're going to do capital controls." And the reason it partially works is because there's usually a grain of truth to it. Usually it's because they've destabilized their money so much that, of course, now people are saying, "Hey, look, if you're going to hold interest rates below the inflation rate, I'm happy going to borrow some." And then they say, "No, no, that's a speculative attack on our currency." It's like, well, no, I was following the economics that you've built into the system, right? So weakness tends to result in more weakness and attacks on that weakness, which is just kind of naturally incentivized behavior. But I do think that's the era that we're going through of various countries trying to devalue their debt relative to their nominal GDP, for example, to do it in such a way that it's not super obvious where possible. Try to do it gradually where possible, sometimes sharply if needed, and then to try to kind of add frictions, at least to certain exits, to make it non-trivial to short what they're doing and buy scarcer things. Even though I think that that's ultimately the solution, it just you have to be kind of careful with how you do it and maybe diversify in how you do it because um, there are going to be pushbacks on people trying to benefit from the situation or at least protect themselves from the situation.
You brought up assets. You brought up gold. You have a service where you manage a portfolio. You share a portfolio with your subscribers. I do the same. I lately have become quite bullish on commodities as well. Some agricultural commodities, oil. I think this is just like the best geopolitical hedge right now is to own U.S. oil producers. Copper, I'm intrigued by. How are you looking at the markets right now?
So similarly, when you think of the 60/40 portfolio, it's a portfolio that really prefers disinflation. You want equity valuations to go higher, you want interest rates to go lower for your bonds, and during recessions your bonds do well, during expansions your equities do well, and that's all kind of geared toward the last 40 years. But there are stagflationary periods, or there are currency shocks, and there are other things, and that's where owning that slice of real assets can be very useful. It could be gold, it could be Bitcoin, it could be commodity producers, it could be directly held commodities, depends on the commodity we're talking about. And so I do think that those having at least a slice of those more inflationary assets in a portfolio helps protect the rest of a portfolio. From those geopolitical issues, from those recapitalizations that can occur, from ongoing fiscal dominance that we discussed earlier. And so, in general, yeah, I try to own either things that are scarce or I try to own business equity and businesses that are shorting the currency. They're issuing long-term fixed rate debt at low interest rates back when they could, and then they're building up real estate, or they're building up commodity deposits, or they're building up infrastructure. They're building up things that are more durable and scarce. And they might have cash equivalents, for example. So they're long-term, fixed rate debt, and then they're holding cash and they have a fairly strong balance sheet and they have all these real assets and they're producing cash flows. That's the type of asset I generally want to own in this environment. And you can have a couple different buckets for different scenarios or different things that can play out. And then the expectation is that on average, those things should do pretty well in this type of macro environment. So yeah, I'm bullish on energy in multiple forms. I'm bullish on gold and Bitcoin. I think tips are if I'm going to invest in bonds, I prefer tips to normal kind of long duration bonds. I like cash flow producing businesses in general, especially if they've got their assets and liabilities kind of appropriate so that they're kind of benefiting from currency weakness, or at least kind of mitigating their harm against themselves from currency weakness. And then I just over time I know there's going to be volatility. So T-bills, for example, if I want to have kind of a lower volatility protection, T-bills, and then I can rebalance back into things when they trim or when they sell off.
Lyn, I could talk to you all day. There's not a topic I don't think that you're not expert on. I can't recommend Broken Money enough. It really helped open my eyes to a lot of things that I didn't understand about cryptocurrency and Bitcoin. How else could viewers learn more about you and your work, Lyn?
So they can check out lynalden.com. I do a lot of free articles, free newsletters, and like you said, I have a low-cost research service that people can check out, lynalden.com/premium. But either way, I'm glad to educate people and educate myself along the way.
It has been truly an honor and a pleasure speaking with you. Thank you for your time.
You as well.
Before you leave, I want to invite you to join my Global Macro Update newsletter. This is a free service that comes out every Tuesday and Friday. I'll send you an email with my latest thoughts on geopolitics, economics, the markets, along with a link to the latest interview and a transcript. If you'd like to join us, hit the link in the description below or go to globalmacroupdate.com and join over 100,000 other Global Macro Update readers. I hope you join us. I'm Ed D'Agostino. Thanks for watching.